I am David Stein of Money for the Rest of Us, and in this video I describe how to lose money trading foreign exchange and what you could do instead if you really want to trade. A week or so ago I got an email from a gentleman that does transcriptions for my podcast. He mentioned he trades foreign exchange and pointed me to his page on a platform called DarwinX. DarwinX is a platform where traders can essentially trade, but you can actually buy in to an individual's trading strategy. And that's what my transcriptionist wanted to know. He said, how long a track record would I need to have before I would invest in his trading strategy? Now, there are $5 trillion of daily transactions in the foreign exchange markets. There's institutions, there's hedge funds, there's governments. There are individuals trading foreign exchange. That means they're buying a particular currency, let's say the euro, and they're selling another currency, the dollar. This is an over-the-counter type market. It's a network, and it's absolutely huge. Now, DarwinX says that we can join the movement. We can move from a passive investor to becoming an active, profitable, consistent trader. Is that really possible? My transcriptionist, he's actually done fairly well. He's up 36%. But he's invested less than $100, and he's only been doing it for 10 months. Many of the foreign exchange platforms, I talk about George Soros, the hedge fund manager that won or gained $1 billion in one day betting against the British pound. The British pound fell in value, it weakened, and he had a $10 billion bet and made $1 billion in one day. What they don't tell you that was in 1992, and it was a very, very different foreign exchange market. At that time, the British pound was pegged to the German Deutschmark. In other words, it was not allowed to freely trade. There was a peg with a range of plus or minus 6%. The UK was in a recession. They were cutting rates, and that was putting downward pressure on the pound. But because it was pegged as part of the European exchange rate mechanism, it was pegged to the Deutschmark. It wasn't allowed to go below that band. So the central banks was in the market buying the British pound, trying to support the currency. Soros and others bet against that, believed that the pound was just too strong. It needed to be devalued. It was essentially the momentum was pushing the pound down, but the British central bank was saying no, the Bank of England, they were trying to keep it propped up because of this peg. That's like holding back water with a dike or a dam. The pressure was down, and eventually what happened in September 1992 is they gave up, the British government, and said, yeah, we're going to let the British pound float freely, and it fell 10 to 15% in one day. That's very different than what the current foreign exchange market is. Now, most currencies float freely. So you have $5 trillion in transactions every day. There's not a currency that's being held back behind a dam that potentially will fall in price. Now, think about again how the foreign exchange markets work. If I go out and say, I believe the euro is going to strengthen against the dollar, I'll enter into that trade. But there's somebody on the other side of the trade that thinks the dollar is going to strengthen relative to the euro. That means with this $5 trillion market, the average expected return is zero. For every winner, there's a loser. And after fees or the spread which you buy or sell these currencies at, it actually has a negative expected return. The expectation is you'll lose money after fees, which means if you're going to be profitable trading foreign exchange, you have to be much better than average. Now, I went on the DarwinX exchange and I looked at some of the top traders, those that were managing over $1 million where others have invested in their trading strategy. What I found is surprisingly the number of losing days where they lost money was about the same as the number of winning days. And that's to be expected in a market where the expected return is zero. Now, they were definitely profitable traders. They were up over 700% in the 3 or 4 years. So there are successful traders. The question is, can you be one? Or is it better, if you really want to trade, to focus on a market that's not $5 trillion? Focus on something where you can actually get an advantage. An example of such a market are closed-end funds. These are mutual funds that trade on an exchange. It's a very, very small market, so institutions aren't playing in that field. You don't have trading bots necessarily, algorithms in that. This is mostly individuals hold closed-end funds because they're expensive, they're leveraged, they're sold to them by their brokers. This is a market that shouldn't exist. But because they trade on the exchange, they can sell at a significant discount to the underlying value of what they hold, their net asset value. So they can trade at 10, 15% discount. And because it's mostly individuals that own closed-end funds, they tend to panic. When markets aren't doing as well or there's a risk of recession, the discounts will widen significantly. And as a trader, you can look at an asset that's selling at 80 cents on the dollar at a 20% discount and buy it and ride it up as that discount narrows and gets back to average. That has a positive expected return. When you buy a closed-end fund, there's an income stream, and you're buying it at a discount to its net asset value. That's what investing is. Investing in something that has a positive expected return. Foreign currency exchange, Forex, has a negative expected return. That's like gambling. If something has a negative expected return, that's gambling. Investing has a positive expected return. That's what we should focus on if you want to be long-term investors, or if you want to trade in something that has a positive expected return and not something like Forex, where across the board, the net return is zero. Hey, if you have any questions on this video, go ahead and leave it in the comments. Thanks.